The latest hedge fund filings reveal a surprising story. Wall Street's elite funds are quietly loading up on sectors the market isn't paying attention to. In this breakdown, we'll explore the sector's top hedge fund titans like Renaissance Technologies, Citadel, Point72, and Bridgewater are secretly betting on, and why these underappreciated plays could be poised to outperform. Stay tuned for some eye-opening trends and contrarian insights that might change how you see the 2025 market. Old-school telecom companies, think AT&T and Verizon, long dismissed as boring, debt-laden utilities, are suddenly darlings of top hedge funds. Steve Cohen's Point72 opened a huge position in AT&T in Q4 2024, buying 15.6 million shares at a $355 million stake. This increase from having no position at all shows a dramatic conviction in AT&T's future. By the way, 2,683 hedge funds now hold AT&T, a strong vote of confidence for a stock that many retail investors left for dead. Ray Dalio's Bridgewater Associates quadrupled its AT&T stake by 402% in the same quarter. They bought 5.2 million shares, making telecom a notable new theme in Dalio's famously diversified portfolio. Why now? Telecom valuations hit rock bottom in recent years. Low PE ratios, high dividend yields, often north of 6%, and heavy pessimism. Hedge funds see a classic contrarian opportunity, stable cash flows from mobile networks and 5G infrastructure that the market has largely ignored. The thesis is top investors are betting that boring is beautiful. Telecom's worst days, price wars, cord-cutting woes, may be behind it. With 5G expansion and spun-off media distractions gone, AT&T's focus on core connectivity could finally pay off. The stock's already up 24% year-to-date, hinting that smart money's bet is starting to pay off. Real quick, if you're getting value from Fade the Herd videos, hit the like button and subscribe. It helps you and other smart investors find content like this. Plus, I've got a few other sectors to reveal here that most traders are overlooking. Okay, let's get back to it. Oil and gas energy stocks, which cooled off after the 2022 oil boom, are back on the menu for elite funds, even as many investors pivoted to renewables or technology. Citadel's number one stock is an oil producer. Ken Griffin's Citadel made a surprising pick for its largest single stock holding, Hess Corporation, symbol HES. Hess, an oil explorer with big assets in Guyana, became Citadel's top long equity position with approximately 1.1% of its $578 billion under management in its 13F portfolio, an eye-opener given Citadel's tech-heavy reputation. Keep in mind that Hess has agreed to be acquired by Chevron, and so Citadel's stake could be part of an arbitrage play, but it nonetheless reflects conviction in oil's value. Hedge funds are also flooding into energy. It's not just Citadel. Dozens of hedge funds increased energy exposure in late 2024. For example, there was a huge leap in hedge funds holding ConocoPhillips in Q4 from the prior quarter. This broad accumulation signals a major rotation into energy by smart money. In fact, even giant Renaissance Technologies had energy names among its top positions. Renaissance Q4 top holdings included Hess via options and Occidental. Plus, it boosted stakes in refiners and midstream companies, playing the value and cash flow theme in oil. So why the attraction to energy? Well, these stocks are cash machines right now. Oil companies enjoyed record profits in 2022 and are still trading at low earnings multiples. High free cash flow yields are being plowed into dividends and share buybacks, yet the broader market isn't giving them full credit. It's clear that top hedge funds see mispricing here. Plus, any oil price uptick would supercharge any energy stock profits, making today's valuations look like a bargain. Hedge funds want to be in before it happens. It's no secret that hedge funds love technology, but instead of just FANG stocks, top funds are targeting niche sectors like technology, cybersecurity, data analytics, and AI infrastructure. There are the picks and shovels plays that the average investor just isn't chasing with the same frenzy as, say, big tech or flashy AI startups. In a surprising move, Bridgewater boosted its stake in Fortinet, AT&T, a leading cybersecurity firm, by 365% in Q4. Dalio's fund added about 733,000 shares too, making cybersecurity one of its fastest growing positions. This came as a big surprise because Bridgewater is a macro-focused fund known for big picture bets, so a deep dive into a specific cyber stock is notable. It signals they see digital security as a key long-term theme, protecting critical infrastructure and data, and it's an evergreen need. Speaking of AI, the legendary quant fund Renaissance Technologies has Palantir, a data analytics AI software company, as its single largest holding. That's right, the fund known for scanning every stock picked Palantir, a company building AI for government and enterprise, above even Apple in its portfolio. Renaissance held approximately 22.8 million shares of Palantir going into 2025. This high conviction bet on AI plus defense tech spotlights how AI-driven software is viewed as underappreciated relative to its potential. Palantir is often overshadowed by bigger tech names, but Rentech's vote of confidence hints at big things ahead. Dozens of hedge funds have been quietly upping stakes in cybersecurity and semiconductor plays that enable AI. Co2 Management, a top tech hedge fund, added to names like Palo Alto Networks and AMD in Q4 rather than chasing only the obvious AI winners. D.E. Shaw and others increased exposure to cloud software and chip makers that form the backbone of the AI economy. Think semiconductor fabs and data center REITs. What's the thesis here? These elite funds are playing the long game on technology, investing in the infrastructure and security behind the tech revolution. While everyone else chases the next Tesla or ChatGPT stock, hedge funds are accumulating the companies that those innovations depend on. This is likely to mean big things when the market recognizes these plumbing companies, quote unquote, face a lot of upside value. For example, Fortinet's critical role in the network security for AI data centers may translate to sustained growth, a story the market is just beginning to appreciate. And Palantir's AI platforms might become indispensable for government and corporate strategy, potentially making them the Intel inside of AI software, a scenario clearly Renaissance is betting on. Another area some famed funds are bottom fishing in is media and entertainment, targeting iconic but struggling companies that the market has soured on. These are bold, contrarian plays on turnaround stories in content and streaming. Citadel's Ken Griffin made waves by boosting his stake in the Walt Disney Company by a staggering 1,786% in Q4. Citadel went from virtually no Disney position to holding about 4.98 million shares. Disney stock had been battered by streaming losses, CEO turmoil, and park closures. Investor sentiment was at multi-year lows. Citadel, swooping in aggressively, suggests they foresee big recovery potential, a successful Disney Plus restructuring, cost cuts, or perhaps value unlocking moves, spin-offs, or even an acquisition. Citadel isn't alone here. Dozens of hedge funds held Disney into 2025 per 13F data, including Third Point and Lone Pine. The consensus among these savvy investors is Disney's unrivaled IP, including Marvel and Star Wars, as well as theme park assets, are undervalued by the market gloom. Steve Cohen's .72 also snapped up Netflix stock in Q4 to the tune of 236,720 shares for about $211 million, even as many believe the easy streaming gains were over. Netflix had rebounded from its 2022 subscriber scare, but Cohen's buy shows conviction that more growth lies ahead. For example, advertising tier success, password sharing crackdown benefits are tailwinds now. This aligns with .72's pattern of contrarian tech media bets they bought when others hesitated. It echoes their Amazon purchase as well, as Cohen added 4.18 million shares of Amazon for $918 million in Q4, another media or commerce crossover giant that was out of favor in 2022. So why the attraction? Content is king, but patience is required. Hedge funds are looking past current challenges such as streaming costs and ad slumps and instead focusing on franchise power and subscriber bases. Disney's ability to monetize its IP across movies, parks, and merchandise is a long-term cash machine, something a short-term earnings miss will not derail. These funds expect mean reversion as Disney streamlines and the economy picks up. Its earnings and stock could roar back. For Netflix, the introduction of an advertising model and paid sharing are new levers for growth that the broader market may be underestimating. Top investors like Cohen are positioning ahead of those revenue boosts. Among these stealthy moves, the sector seeing the most strategic accumulation by elite funds appears to be energy, with Telecom a close second. Why energy? The data shows broad participation. Dozens of top funds boosted oil and gas stakes simultaneously, drawn by low valuations and high cash returns. It's a classic smart money contrarian trade that many of the best performing funds agree on. Telecom, while drawing huge buys from 0.72 and Bridgewater, is a more concentrated bet by a few funds rather than an industry-wide trend. The bottom line is hedge fund legends are looking where others are not. They're bargain hunting in unfashionable sectors such as telecom and energy before the crowd realizes the value. They're investing in the infrastructure of the future, cybersecurity and AI enablers, rather than just chasing today's hype. And they're willing to back iconic franchises like Disney when sentiment is at its worst. True to the mantra, buy when others are fearful. Each of these contrarian sector bets comes with risk, of course, but that's exactly why the potential rewards and the interest from hedge fund masterminds are so compelling. As viewers and investors, keeping an eye on these heavy hitter moves can provide clues to the next big market opportunity. If the pros are right, today's overlooked sectors might just become tomorrow's market darlings. If you're serious about your money and want to think like top hedge funds without needing a billion-dollar fund, subscribe now. We break down the timeless playbook translated into modern opportunities and help you invest with clarity, even when markets are chaotic. Like and subscribe for more smart money investing ideas.